Alright guys, I'm back. I'm back. It's good to be back. So I'm gonna give you an explanation as to why I didn't have time to do anything this past week. As I stated before on the community page, that it's been draining emotionally, physically, and mentally. Honestly, this past few weeks, been dealing with family emergency. Um, Long story short, though, it's better now. It's still going through it, but I'm hoping for the best outcome. And then on top of that, I was purchasing a new used car and over 100,000 mile, and that whole thing transpired into weeks of battling with these people that I bought the car from. And so it took some times out of my free time to do the video, and it just felt like I wouldn't be able to give it my all anyway, and it would just be like mediocre analysis here and there, and just to have the video out there. And honestly, I feel like I want to add some value into what I say, and so that's why I just don't want to frivolously just I'll make video just because I could make it, right? And on top of that, I'm not saying that I'm giving the most valuable thing now either. I'm still learning. I'm still, trying to go through this journey with you guys. And honestly, it's just for my personal growth here in terms of speaking, in terms of, presenting my idea through words, because I'm not very good at that. So again, just trying to be better at it. But anyway, so that's just a brief explanation, and welcome back to my channel here. All right, so let's go through this. Of course, I think I've shown you this website before, and it's just a easy way to kind of take a look at the past earnings and past expenses, whatever. Now, one of the things that I kind of want to point out, I don't want to make this video too long, but who knows, it might be 5 hours of me ranting about this. No, I'm kidding. Now, here we go. So this one right here is kind of catch my attention, right? And now, if you look at the cash position versus debt, it's an indicator of financial position of a company. It is calculated by taking the total amount of cash and cash equivalents and subtracting the total debt. Okay, so if you do that, GameStop still have well over $500 million. Okay, or $750 million. How about that? So that's a good position to have, right? Now they in the past they had more, and if you look at when that was, it's 2020, 21. Okay. Let's see, and of course they have more cash back then, I'm sure, because they were just selling, a whole bunch of shares at a very high price, and they got some like $2 billion cash. And what did they do right away? They pay off debt, right? If you look at, hold on, I'm trying to get to the debt here. Total debt, debt growth. I'm sorry, I should have looked at this beforehand. Oh my God. Now, this total debt, if you look at total debt, is the amount of, it's the total amount of liability categorized as debt on the balance sheet. It includes both current and long-term or non-current debt. So if you look at the formula there, current debt plus long-term debt, okay? Now, in order for you to look at the breakdown of this type of debt, you have to look at the balance sheet itself, right? Now, this is, again, just a summary of things so that you could kind of take a quick look at what the company is doing. So in this is again just my opinion, learning as I go here, that the more money you have when you kind of total cash minus total debt is the better. Okay. Now comparing that to another company that claims to be the other one, meme stock, not Bed Bath and Beyond, but this one, AMC, right? If you compare that to AMC, yes, look, they have, hold on, if you look at, see, revenue per quarter is say $4 billion, right? They have more revenue. Yes, their revenue come kind of, this is annually up 50% from the low of the pandemic, right? Quarterly 21%. I mean, pretty good. Okay, but let's look at the debt. The same category as I showed before. Total cash minus debt. Look at this. In the minus. It's in the negative. Are you telling me that that is a better company than GameStop? It's not, because they're too big. Their debt is too high. And so when you're saddled with debt like this, that is why they needed badly to dilute the shareholder value. That's the only way they do it, but they could do it, right? Otherwise, file for bankruptcy, just like Bed Bath and Beyond, right? So, let's see, what else do I want to talk about? But if you look at the inventory, right? If you look at the inventory, it seems like it's going down, right? Is that necessary a bad thing? No, they could always add more to that. To me, if you look at the quarter to quarter, they had $1.1 billion worth of inventory from the previous quarter. Why? Because they want to be ready for quarter four, which was, the best quarter usually, right? Hold on. Yeah, $2.2 billion in sales. So that's a pretty good chunk of money right there, right? From the inventory, from $500 million or so of inventory that generates the cash of $2.2 billion in revenue. Now, is it directly correlated to that? Not really. Of course, you have to look into other stuff. Inflation and all that stuff. So, all right. And what else do I want to talk about here? Of course, I was looking at the store number, but I think it's on here. Let's see. Sorry, hold on 1 second. All right, I think I found it. So see if look at the number of stores, right? So what I want to point out here is that they're closing down. I mean, that was from, let me see, from last year to this year. They closed down close to 200 stores, right? That's not too bad. Right? That's worldwide too, right? And they still have a pretty substantial amount of stores to, kind of capture that sales, right? But most of the sales should comes from e-commerce, and that's what they are ramping on, or at least focusing on growing is an online presence, right? And I think they are doing a pretty good job at that. Is it a knockout sale? No. I mean, it's still, at the whims of the economic growth that we have, and everybody is struggling. If you read, retail in general, there's been sales down everywhere, even Amazon experiencing the same type of, thing. So, again, I mean, it's in line with what the economic current situation is. In my opinion, they do a lot better than most company out there. And on top of that, look at the gross profit. I pointed this out before, is that they are up from last year, even though the sale was down. See, up by what? Around 20 million, right? Yeah, around $20 million increase right here. $22 million increase. That's pretty substantial, right? 22. I mean, how often do you get to make $22 million? No, not often. That's what I'm trying to say. All right. So if you look at the region, right, from the breakdown, of course, the U.S. has been down by 2% in sales, and Canada is the only one that is up 4% in sales right there. So that's a good place to kind of focus on. Australia, which is where Matthew Furlong is from, is the same, like close to the same anyway. 0.5% down. Okay. Okay, I'll be right back. All right, I am back. So what I'm trying to find is the long-term debt that is noted on the other website right here. Total debt. Like the only item that is close to that amount is this particular item. So it's other liability. So it's not like a long-term debt or whatever, like they said. So it could include anything from, account payable or something like that. I need to do more research on what this means. I'm sure it's in the annual report here somewhere. So I'll take a look at that in the future video. But as far as like the long-term debt, I pointed this out before. It's been paid close to zero at this point. And then also there's another one of $40 million right there. When it used to be over $100 million there. So they are paying off debt, and that's a good thing, right? And on top of that, they use some of the shareholder equity, which right here, to buy some government bond, right, or government security, which means it's more secure, right? You may be scared because of what happens to, a whole bunch of banks' failure of when they were, the reason why they fell is because they bought government bond 10 years ago that has low interest rate. So when you do that, the value of the bond went down when the interest rate is high. So that's why, when people are asking for money, they tend to go bust because they have to sell that particular bond at a loss, because right now the Fed is raising rate. So every single bond that they bought 10 years ago is becoming less valuable. So what does that mean? It's a good thing that GME is buying the government bond right now because it's at a lower price, right, than it was 10 years ago. The reason being is that if the government or the Federal Reserve start to lower the rate again at some point, now we don't know when that is going to be. It's based on what the economic data is. For some reason, job market is still strong. Obviously, they're going to try to, put people out of work in order to tame this inflation, right? Rather than, having billionaires lose all the billions of dollars. They rather bail those people out just by bailing these banks out, bailing the depositor who have billions of dollars in the account. I would argue that would have tamed the inflation right away, because these people don't have $1 billion to spend anymore, right? And but you don't have the government that works for the rest of us. They the government is working for the top 1%. But anyway, I'm just rambling on here. But you have back to this marketable security here. I think over the 10, 15 years from now, this security could 10x, you never know. When money becomes cheap again. We just don't know when. Like I said, it could be 5 years from now, could be 3 years from now, could be a year from now. Who knows? But it happens in cycle, right? The main thing is that this company is not going bankrupt anytime soon. So that's all you need to know. All right, so I think that's all I have for this one. I hope it's not too long, and thank you for watching. Okay.